Good day, everybody. This is Jim Kinney for the OptionProfessor.com weekly update. Of course, this is now February 1st in 2019. As always, I do remind you that past performance is not necessarily indicative of future results, and short-term trading, option trading, does involve substantial risk and is not right for everybody. So check with your advisor, your clearing firm, and your good common sense before you conduct any business in these areas. Way of introduction, I'm Jim Kinney, and I'm a graduate of Boston College. Been in the investment arena here for decades. I've educated thousands of people at my live seminars and webinars on the uses and risks of options. So I'm very familiar with all the different markets. And today, as always, I give you my views and my opinions on what I see happening. Right now, you can see on the screen here, we're up about 164 on the Dow and up about 11 on the S&P. Today's big news, of course, is the jobs report. And of course, it blew the cover off the ball. Over 300,000 jobs created, and 165,000 was the estimate. So that's a pretty big beat. That's the good news. The not so good news is that they revised last time when we were up 322,000 jobs down to 220. So this number here may be made in putty as opposed to cement. So be careful of that. But by any stretch, it is a situation where the number was way higher than expected, and it's caused some positive reaction. The thing I was looking at here is wages. Wages on the report shows an increase of 3.2% year over year. But if you look at the aggregate, which is all wages, all incomes, it's now at 5.5% annualized, up. And that is basically the highest in about 13 years. And I don't know, but that sounds to me like a high number when you compare it to a 2.2% Fed funds rate or a 2% Fed funds rate area. So that'll be interesting to see if inflation, because my belief has been that in the first quarter here, companies are going to increase prices. And I see as I go around town in my lifestyle that prices do seem to be rising. And if those numbers start appearing in the CPI numbers to go along with wages, then this pause that the Fed is involved in now may not be long-lived. It could last through the first half of the year, but the second half of the year may be quite different as far as what the Fed is going to do. They don't want to get behind the inflationary curve. There is absolutely no inflation being discounted in the long-term bond market. So obviously, when nothing is being discounted and you're driving down the road at 80 miles an hour and it doesn't seem like there's a cop around, that's probably when there's going to be one in your window. So the bottom line is the lack of concern about inflation long term, to me is worrisome because nobody's worried about it. Okay. Now, what else is happening? I'm going to give you a little round table, then I'm going to get into some specific areas. Energy stocks are doing pretty good because Chevron and Exxon announced their earnings, and because of the Permian output addition, they are announcing pretty good numbers. Let's take a look at Chevron here while we're talking and get an idea of what's going on. I think it was bid up pretty good. Yeah, it's up 2.31. Again, there's a gap there between about 104 and 106, let's say, park figures, and we're at 101 and change. So it still has a little bit of real estate it could go. And then if you connect those tops, that top, and maybe a little bit higher, that would be a nice downtrend line that is running into. So again, it does look like it's looking pretty good technically, but it would have some resistance in my view at about 106, just like it went into the gap here at about 108, and then it went into the tank down underneath 95. We could go into the gap here between 105 and 106, and it could be coming down from there. It's hard to say. Let's just say this. Let's look at the moving averages. Always try to keep a look at the moving averages. They're based on time and price, and they're not negotiable. Opinions obviously can change and are all over the place. Now you can see it's above the 200-day, which is a good sign. Okay, so we need to stay above the 200-day at 130, right? 30 cents there. But the 50-day is still underneath the 200-day. So that's why it's important that this rally that we're seeing in the general market stick for a while. Because if it cannot stick for a while and it rolls over, these moving averages that have crossed are going to come back into play. And they could be, again, a real ceiling or a cloud above the market. So again, nice action, back, definitely looking like it's trying to make a turn. Now time is the key. Can it hold its water? If it can't and it starts going back down, then of course that could be problematic. February is going to have a lot of information going on. The trade thing is supposed to be settled in February because on March 1st, we're supposed to increase tariffs if we don't hit an agreement. And I can tell by the way Trump is talking that he probably needs a win here. And so he'll probably put something together in the month of February if I was a guessing man. Whether it be anything that sticks or not, who knows? Obviously, getting them to buy gas and getting them to buy soybeans is a no-brainer. Getting them to stop intellectual property violations, that's a different issue and probably a tough one to enforce. Okay, what else is going on? You got the Chevron story there. Let's take a look at Amazon because Amazon came out with earnings, and people have not exactly been embracing it, at least after they came out. Let's see what's going on here as far as current price. Yeah, right now it's down $71. Okay, and that's why you got to be careful of what could be bear market rallies because they can be sharp, they can be vicious, and they can also evaporate pretty quickly. I think the 200-day average is right around 1650 though, so we're really vacillating around what I would call the mean price. Now, what's the problem with Amazon? They had revenue that was a little bit not as great as, and supposedly that Prime service is not growing or slowing down the growth a little bit, and that's one of their big bellwethers. But the bigger news is in India, where obviously they're trying to get their business going along with Walmart. I think I'll show you a Walmart chart. Supposedly there's some things happening over there with regards to their growth that is causing problems for Amazon and also for Walmart. So there you got Amazon. Let's get that 200-day average so you get an idea of what's going on with the moving averages. And again, it does look like it tried to make that low, 1,300 and change, right? But it bounced back $400 pretty quick. And look at that 1710 number, right? Can't get above 1710, rolling back over. I guess it got above a little bit yesterday, but didn't like the altitude. That's why I'm saying be careful up here. This is an area where strategies such as collars would make a lot of sense. What is a collar? You sell out of the money call, you take the premium, and you buy a put. I was just listening to one of the people who higher ups at Citigroup on Bloomberg, and they were discussing some tactics similar to that. They didn't explicitly say the collar, but they did say they had some kind of an idea where you cap the upside and then you put a limit on the downside. That's what the collar is all about. When you want to put a collar on? Near a high point, like when Amazon was at 2050. And I was telling people that 1,500 was the 200-day average. No way we're going to keep going, in my view, when you're $500 above the 200-day average. So what should you do? You collar it. Why? Because you sell the 2,100 call, you buy the 2,000 put, or whatever numbers you choose. And then when it goes down to 1,300, 1,300 is off the table because you've got to put it 2,000 or whatever strike you chose. That's why you need to know these strategies. You know, people come to the meeting, and I do encourage you to tell others to come because I have no axe to grind. I am going to give you the straight talk as I see it in my view. If you have a question on a strategy or any of the things I'm talking about, just shoot me an email at optionprofessor@gmail.com. That's optionprofessor@gmail.com. And I'll be more than happy to try to give you a hand with whatever you've got cooking there. Okay. All right. Now let's talk about Walmart, because that's what I did tell you was the other retailer that's supposedly going to get whacked because of the India situation. Let's see. All right. Walmart. Let's go Walmart. Here we go. Okay, down again, a little bit of that is supposed to be involved with, again, the India situation. P ratio 53, according to my screen, doesn't look like it's cheap stock either, so be careful of Walmart from that aspect. And where's the 200-day? It's at 91. So, again, very similar to Amazon. Jumps up here. A little bit above the 200-day and the 50-day. But if this thing can't hold water and you start seeing anything in the 80s, that would be something to be concerned about if you're in Walmart. So as long as it can stay in the 90s here, you know, that's a good thing. And certainly getting back above last week's high would not be terrible either. So 105, you can see there's resistance there. I think that's pretty much one of the all-time high prices. That happened in February of this year. And then, of course, it has come back down. All right. So again, when prices are high and you think they may roll over, and for whatever reason you don't want to get out, you can do the collar strategy. If you sell an out of the money call, it does give you further upside potential. But by using the premium to buy a put, it puts ground floor underneath your equity. And I think there's many of you out there who would not have minded having a ground floor in your equity during that December debacle. So again, not familiar with it or have questions, shoot me an email. All right. What else we got cooking here today? We had Facebook had a big rebound here. Um, their numbers and their talk seem to be positive, so people have been getting keen on them. A big gap there between 190 and 210 from when it came down. I don't know that it has the guts to get up that high, but now there's a gap underneath it between 150 and 170. Okay, so this thing has turned around a bit. I'm sure the moving averages are going to reflect that to some degree. And let's take a look here. The only negative news I heard on that was Angela Merkel from Germany has dropped her page on Facebook because I guess she's changed her job description, doesn't need it anymore. But that was on the tape as well today. At any rate, you saw the moving averages in the 170 area. What was it? 166. And where are we trading? 169? Yeah, 169, 170. So this thing starts getting back underneath 166 again. Again, this would be something that had a very big rally that if you think it might go back down a little bit or not go up very much, again, the collar tactic might be something to consider. But understand the use, the risk, and all the ramifications of every strategy before you even entertain it. Okay? All right, here we go. What's up next? What's up next here is Honeywell. Honeywell came out, gave pretty good numbers, and again, they did say that the landscape is a little bit weaker, but they are getting rewarded for their good numbers. And as you can see, Honeywell has taken off from that big drop. So 125 all the way back to 150 today almost, and now you're at 146. Should you fade this rally? Let's take a look at the moving averages. The moving averages are, oh God, hold on here. Let's get back on. Okay. Let's get back over here. And as I'm doing that, there's another stock that's in the news, General Electric. I'll get to that in 1 second. So let's talk about Honeywell real quick here, and let's look at their moving averages. Because again, that's been a very good performance since the drop in December. But let's see if it's a situation where it may be in an area where it may roll over. Let's take a look on the moving averages. Let's see what they give us. All right. And again, the next one I'm going to talk about is General Electric. Okay, 144. So again, similar to many of these companies, we've run up to the area of resistance, basis the 200-day. We've exceeded it to some degree, but what do you think the important thing to do now is? Have these gains hold for a while, because if they don't and it goes back in the soup next week or the week after, there's going to be some risk to go back down and do some retesting of those December lows, which some people are calling for. Now, the VIX is another thing that I've been watching. Let me show you this real quick, and then I'll get over to General Electric. VIX 1634. Remember, I told you if it's between 10 and 15, you're probably going to be in an uptrending, stable situation. If you're between 15 and 20, then you're in a risk for a downing type move in the market. And if you get above 25 on the VIX, then you could go into one of those parabolic drops, like we saw, in October, little bit, and then we really saw in December. And then you can see this is January, February, when the VIX goes above 25. Look out. You could be in a real dangerous situation. So right now we're between 15 and 20. And if this market is not going to get above 2750 on the S&P and roll over, this would be the neighborhood, again, where you'd investigate the collar strategy or some type of married put strategy to protect your equity a bit. Some people are saying that they were looking for a 10% total return this year. Well, the S&P is up 7% this month, and if they pay a dividend of 2 or 3%, sounds like most of the gain might have already been made in the first month of the year. So you got to be a little careful here because, again, the earnings seems to be slowing down, if not rolling over. And when earnings roll over or slow down, it's a rough racket to get the stock market to go a lot higher. That's my view. That's my opinion. Let's look at the transportation average. Well, before I get into that, let me give you that General Electric I talked about. General Electric obviously is a company that's got wiped out. It used to be $60 a share. It went all the way down to like what, $8 a share, $6 a share. Look at that, $6 a share. Look at that, 666. That's a pretty evil number. Anyway, that is where you are. And it had a huge, huge jump up in volume here because their aviation business is doing great. And everyone is focused on that. And they're hoping this guy who they brought in is going to be the big turnaround artist. Well, he may be, but it is a situation where there's a lot of reality behind the curtain here. So you got to be a little bit careful buying into a huge run up in a stock that's been in overall a very big downtrend for a long time. Let's look at the moving averages. See that gap there between like 9 and 10? That would be something I'd be thinking it could come back into. Let's see if the moving averages give us any more clarity. But that's big volume that it jumped up on lately. And so basically 52 million shares today. What do you call it? And it's just started out. And normally in the last 200 days, 92 is the whole volume. So the volume has been picking up. But there you go. There's your 200-day average. It's like a big ceiling, $11.60. I don't want to be buying something at 10.50 or 11 if I think that 11.60 might be as far as it goes. So bottom line, it could be a good deal down here. But again, aviation is the big shining star. And they got plenty of other businesses that are not doing that great. So you got to be careful when you get into a company like this having a sharp, what would one call a bear market rally. Okay, let's look at the transports. Trying to give you as many tea leaves as possible to get a flavor for what's going on. And then I'll give you my view. There you go. You've got the transports up 38 today. And again, if you connect those tops, it could have a little bit further to go. I see 10.5 as the upward limit, just like I see 27.50 as the upward limit on stocks on the S&P, if it can get there. But there you go, 200 days at 10.571. It's a declining 200-day average. And so obviously you're having, in my view, a bear market rally. And what do you do during a bear market rally is after you feel like it may be near the apex, you consider strategies that involve puts, and then you consider strategies that are called collars to try to protect some of your equity so that if it does go back in the soup, you've done something to stabilize your equity. That's basically, what I would be looking at here, and as far as that's concerned. Now, let me see if there's anything else here, because I do want to get into some sectors that could be pretty good. Again, a couple of other things in the news. Trump just got out of the NATO deal. 30 years we've been in it, and all of a sudden we're out of that deal too. So we're running around town with a whole bunch of no deals right now. And I hope that works out for us, because as a nation, we certainly want all of that to go our way. With regards to anything else? So Venezuela's guy, Maduro's trying to sneak out 20 tons of gold, and a Russian airplane was at the airport. No go on that. So the Russian plane went back to wherever it came from. And that's the cloak and dagger stuff going on in Venezuela. And let's take a look at right now some of the sectors. Okay. The big one, and I brought it to your attention a while ago, is EM. And so this is the emerging markets ETF. Now, it's had a very, very big run. $7 billion came into this thing in the first month of the year, into this ETF space of emerging market. That's the second most ever. So obviously, there's a big commitment here that this thing has turned the corner. That is possible, but it's also, a little bit dodgy, like everything else is right now. Why is it dodgy? Again, because the 200-day average is still trending lower, and it comes in just underneath this. Have you noticing a theme? You got a 200-day average that's dropping on all of these things I'm mentioning. A lot of them have gotten above them, like Amazon, but Amazon's back under. And this EEM, again, went to 42.83 today, and it's at 42.46. So what do I tell you? If these things can hold water here and turn these averages, then, of course, I'll jump on the bull train. But I don't want to be buying the top of a rebound rally and find out I'm holding the bag. Because somebody is fading this rally, as always, somebody is fading. In other words, when we're crashing in December, who's buying? And we're rallying through the roof here. Who's selling? You got to think like that, because, again, somebody's taking the other side of the trade. And one of them is going to be smart. And again, during the drop in December, the guy panicking out and selling out, Who was buying? That guy was a sharp guy. This thing's rallying up. If this thing rally does not continue, who's going to be the smart guy, the seller or the buyer? Only time will tell. My suspicion is if these things don't hold, the seller up here could be the sharp guy. Okay. Um, so that's emerging market. Clearly looking like it's trying to turn. 39.42 area, very important. Let's see if it can hold water. If it can, there's plenty of upside because the thing used to be at 52. And I was told that there's the biggest amount of middle class in the world is going to happen in Asia. And they have a savings rate over there of 40%, whereas our saving rate is 20%. So they got a lot of consumers in the long run, and they're going to have a lot of people in the middle class in the long run. But the long run could be a longer run than we know. But certainly having part of your portfolio exposed to this from time to time is probably going to be a decent idea if those demographics are an indication of what might happen. So I would be, again, open to the sector for sure. The question is it going to be making a turn? Are the lows in that were made this year in the 38 area? And if that's the case, then obviously down here is not a bad place to accumulate. But again, the verdict, in my view, is still out because those 50 and 200-day averages are still inverted and pointing down. Okay, Europe, I think, sounds like a big mess because the ECB, their balance sheet represents 40% of their GDP. That's very leveraged, okay? And so that's why I'd be a little concerned about Europe here from the standpoint of what? That they could have some more problems. Why are people running into the bunds where the German debt when they don't pay any interest? Why? Because they don't want to probably have their money in the euro, because the euro and the ECB are linked, right? And if the ECB is running a deficit that they can't get out of, and they can't go to any kind of tightening or even neutral policy, then that could have a diluting effect possibly on the currency. If you want to see a diluting effect on the currency, go look at the British pound. I remember back in the day, that used to be way over 200. Now it's down in the 120, 130 area, and Lord knows it could go to parity to the dollar, and that would be losing over half its value. So if you're over there in Britain and you haven't done any hedging, I'm sure that's not a good thing for you. But anyway, let's take a look at Europe here, and you can see that it is trying to turn here. But again, like most markets, is it a bear market rally or is it a turn? I think more time is needed to make that statement. I suspect it's a bear market rally because of the averages trending lower, and those averages don't turn around on a dime. So be careful of this rally is my view, but it could have a little bit more legs. Let me show you the S&P. The other market that people are plowing into is back into tech and back into the Qs. So that's where the money flow has been jumping into, emerging market and the tech again. So, sometimes massive money flow into something is not a good thing. Go ask the Bitcoin people. Okay, so here you are, 2708. I thought this neighborhood would be problematic right around 2710, and it could be, or it could have a little bit more of a leg. Let me show you why. Hold on here. Okay, you see, you can start connecting the tops a little bit into this neighborhood here. I think next week's very big week for this. If this thing starts rolling over under 2690, 2680 on the S&P, it's a good shot that this is another rally. If it does not, I think the next stage up is around the 2750 ballpark area, because where's your 200-day? 2741. Well, most of these markets have peaked through their 200-day, right? And a guy who I know who's a trader was pretty sharp. He said after this drop down to 2350, with the moving average up at 2741, I'm buying every dip. And has that been the right thing to do? You bet it has, because he believes it's going back to the mean of the 200-day average, 2741. So buying every dip since December has been a moneymaker, because this market does seem like it's on a destination towards this 200-day average. We hit 2716. That's not that far away from it. But if maybe they get a deal with China between now and the end of the month, and they bring it up to 2560, 2760, 2750. And then if that's all he's got in his tank as far as good news is concerned, maybe that's the neighborhood where it rolls over from. But if I tell you something's at 2710, and I don't think it may have potential past 2760, 2740, then you certainly wouldn't want to get tremendously bullish up here, I don't think. Now, again, if it can hold above these numbers, 2609 is the 50-day. If it can hold above these numbers, then it's a different deal. But you might see a situation where it's buy the rumor, sell the fact. What does that mean? That means they're bidding up the price. They're looking for what? The Fed pause, which is in, and they're looking for the China deal, which is coming. And if it does happen, it could be a sell the fact because they've already bid it up so fast. Again, be careful of a market that has gotten this kind of technical damage, that has a big spike back up, because the likelihood that we've had that the longest bull market in history is going to be having the shortest bear market in history probably is not going to happen. But it could. But again, I wouldn't bet that way until I see more evidence above 2750 on the S&P 500. And again, what do you do when markets have a big rally like this? You start looking at the collars, you start looking at your married puts, you start pricing out things that protect your equity in case it does roll over. Again, the budget deficits are going to be huge. They were huge last year. They're going to be huge again this year. The Treasury's got a lot of borrowing to do. And everyone says the Fed is out. They're paused. They're not going to ever hike again. So the sentiment on interest rates have gone all the way over the other side. And my view is that in the second half of the year, you could see some inflation. You could see some price action. And with the big deficit coming, it could put pressure on the bond market again. The U.S. dollar, I think the reason they paused is because they want the dollar to drop. And why would they want the dollar to drop? Because of the companies, they say like 40% of their revenue comes from overseas. Well, if the dollar drops, it's going to help those companies where they're getting hurt now because of the strong dollar. So let's take a look at the dollar here. You can see the highs are getting a little lower, right? So that is not bullish. And the lows got a little bit lower here. But we need to take down 95 and 94 for this thing to turn into a full-fledged rollover. Right now, it hasn't done that yet. So that's why patience is very important. But the direction of the turn seems to be trying to go in the downward phase. And if the Fed is on pause till June, that could be enough weight to bring this thing back down. Again, it's possible that the Fed's tactic of pausing has nothing to do with the slowdown, but has something to do with getting the dollar down so that they can do what? So that they can have better earnings of these companies who get their earnings from overseas, because a lower dollar would help them. Okay, one other thing that I've been watching is the gold area. And the reason for that is if you're going to drop the dollar, and inflation is going to come back. Wage inflation, I already told you, aggregates 5.5%. If they start hiking prices, which I think they've already done, I don't know why it hasn't shown up in the numbers. I guess because oil's down a bit and real estate has leveled off. But most other things seem to be popping up. You can see this thing here on the gold, which I talked to you about for the last month, 2 months, down at 17 and 18. Is now got to 19, got to 20, broke above 21. This is all positive, okay? But now it may have a pullback. Okay, because that 23 number you can see is very difficult. And gold got above 1100, got above 1200, got above 1300. It needs to get above 1400 to be a full-fledged breakout as far as I'm concerned. So again, like many of these markets, they've come up into resistance. Now we need to see them either get above resistance or hold the higher levels before you can make the statement that it looks like the turn's in effect. Okay, because right now it looks like just a big rally in a lot of stocks. But having some of your money in this, there's a couple things that I've been looking at and have seen go up about 17% since the last summer. 17% growth in this thing. Well, what's this thing? It's gone from 18 to 22. That's $4. $4 into there, you got 20%. So you've been up 20% in this area. That's not a bad sector to have parked some money. Okay. Another place that people are parking money, and they have not been unhappy to do it, is in the REITs. And this Annaly REIT, is yielding 11.54 according to my screen. And if you look at it, since we had the big drop in December, this thing has been trading between 975 and 1050. And you're getting a yield of that kind of yield. And the PE ratio is 4.2 according to my screen. This doesn't look like the worst thing in the world. Investigate it, though, like anything. Investigate it, find out all about it, make sure it's suitable for you. But this is something that has obviously been a good place to hide during the big drop of December, and not a bad place to be in the first month of January. Okay? All right, we're getting down to closing time. We covered a lot of stuff, and that's why I always say, you got a question on something, shoot me an email, optionprofessor@gmail.com. And also, do let friends and associates know how to get on the website, optionprofessor.com. Click on the link and attend every Friday at this time to hear basically my views and my observations. Until next Friday, I want to wish you all the best weekend. Got a Super Bowl weekend, so we got a little bit of fun coming in here. And if you're for the Rams, I hope the Rams win. And if you're for the Pats, let's hope the Pats win. Being from Boston College, I guess you know which way I'm going. But you never know in the Super Bowl, anything can happen. Thanks a lot for being here. We'll see you next Friday. Good luck and good trading.